What's going on, guys? Welcome back to the channel. Welcome back to another video. It's Ron here. Hope you guys are doing very well today. If you're brand new to the channel, please consider subscribing. And while you're at it, go ahead and smash the like button. I would totally appreciate that. So in today's video, I want to talk to you guys about what is coming down the pipeline and how to get ready, how to prepare for what is coming. Now, at the end of the day, the goal is financial freedom, right? We don't want to be caught off guard and be potentially set back by a lot of these things that are coming down the pipeline. And I also want you guys to understand, what does it take to actually build wealth in this new age, in this new economic environment, all right? So the first thing you need to understand, so that you don't make the mistakes that I made years and years ago, there's no reason why you need to keep making the same mistakes, losing money, and potentially being wiped out by what is coming down, right? Now, we've already seen a tremendous amount of activity coming from the Federal Reserve. Fed Chair Jerome Powell is on a warpath to reduce inflation, and by doing that, he is wiping out businesses, banks, retail as we know it. Stores are being shut down, and it's wiping out a lot of wealth. But at the same time, it is creating a tremendous opportunity that I want to make sure that my audience is in a good position to be able to take full advantage of, right? And this is what the billionaires of the world have done over the years. They've built their wealth. They've increased their net worth to astounding amounts. You know, the likes of Jeff Bezos and Warren Buffett, Ray Dalio, right? And they're paying attention to these patterns. And what I've shared with you guys over the years is that pattern recognition is one of the most valuable skill sets that you can learn. One of the most, right? Because if you can recognize patterns and recognize them early, then you can put yourself in a situation to capitalize and profit from these patterns, as long as you're aware and you take action, of course, right? So one of the things I want to talk to you guys about today is the fact that these banks are setting aside lots of money for potential bad loans, all right? And who am I talking about? Well, there's a lot of banks that are preparing, but let's just talk about Bank of America, JP Morgan Chase, Citibank, Wells Fargo. These companies are preparing for lots of bad loans to hit the books, right? And with good reason. The Federal Reserve has raised interest rates 25 basis points yet again. The Fed has been raising interest rates for the last 14 or 15 months consistently without a break in raising interest rates, right? So of course, he started off with multiple, first of all, it was like 50 basis points for the first interest rate rate hike back in March of 2022. Then it was 75 basis points rate hikes 4 times in a row. We have never seen that in history, right? And now we're at a point where the Fed is pretty much seeing that inflation is coming down. There's a lot of economic reports that are coming out saying that the economy is still strong in spite of the punishment that the Fed has put onto our financial system. But the banks are starting to give out. So the banks are starting to give out, and the Fed is realizing, hey, maybe we need to let off the gas a little bit. Let's just see if the decisions, the economic moves that they have made has actually made the impact that they're looking for on the economy without destroying and completely collapsing it, right? So now the banks are seeing what's happened. We've already seen Silicon Valley Bank collapse, First Republic Bank collapsed, and as well as Signature Bank collapsed. How many more banks are we going to see collapse, right? And again, when the Fed makes interest rate hikes, the effects of those decisions are not felt immediately. They're very delayed. So it is quite possible that we could see significantly more banks collapse. But the thing is the wise are paying attention to the patterns that we talked about earlier, right? They're paying attention to the patterns. So they're strategically setting themselves up so that they can take advantage of cheap assets. As asset values decline, they're going to be able to scoop up these assets for pennies on the dollar. And in fact, JP Morgan Chase just did this the other day. They bought up billions upon billions of dollars worth of assets, pennies on the dollar, from First Republic Bank. They were in a bad position. PacWest is likely going to be in another bad position here shortly. I mean, they're kind of already in not the best position, especially with how much exposure they have to the commercial mortgage-backed securities, the CMBS. Commercial real estate's getting destroyed. So, these are some of the reasons why these banks are preparing for bad loans. Layoffs. There's an incredible number of layoffs, thousands of layoffs that are happening from many of the big S&P 500 companies because they themselves are preparing for the uncertain markets, right? And so the softening of the economy is due to the increase in short-term interest rates thanks to the Fed. And the other thing is a recession becomes an increasing possibility if unemployment increases and people start losing their jobs. And so the banks, Bank of America, JP Morgan Chase, Citibank, and any other bank for that matter, they're looking at the fact that, hey, people will continue to lose their jobs for the foreseeable future, and they need to set aside money so that that they can be able to weather the storm and not get wiped out like the 4 banks that have already collapsed earlier in this year, right? And so how do we capitalize as, regular individuals, regular people like me and you, investors, people who are we're still trying to build our wealth here, right? So how do we capitalize? How do we position ourselves and prepare for what is inevitably coming, right? So the thing is number one, you want to get out of debt, right? Whenever the Federal Reserve is raising interest rates, as they're raising interest rates, the cost to borrow money is increasing. If you have a Visa credit card, a MasterCard credit card, an American Express credit card, a Discover card or major store brand, Walmart card, Home Depot card, if you're carrying a balance on that card, it's going to become more and more expensive to carry that debt. And so it would be wise to strongly consider wiping out that debt, clearing out that, becoming debt free. All right. Now, this is like step one. Now, I don't want to get all complicated and talk about how to use debt to make money and create passive income. That's not what this video is about today. I want you guys to understand that there's a lot of detriment to carrying variable interest debt, and especially if this is high interest credit card debt and other high interest loan debt that is not making you money. And understand the vulnerable situation that you're putting yourself in by just continuing to carry that balance month over month, right? The last thing you want to do is get hit with a layoff or some type of interruption in your income, especially if you only have one stream of income. You'll be setting yourself up for failure. And a lot of people don't realize that the game is changing right now. Don't be one of those. Don't be a statistic, right? And the other thing is you need to focus on and understand that this is not financial advice. I've gotten burned enough over the years that, I understand the game and I'm just sharing my own personal experiences. But for me, I would say to myself, I would say to my younger self, to my son, I would say, building an emergency fund of at least 3 to 6 months of expenses. Have it set aside. Now this is not money that you're going to be investing in the stock market. This is not money you're going to be trying to create passive income off of. This is the fire extinguisher in case of emergency that you would use in the event that there's an unforeseen emergency. You need to have basically kind of like, some type of airbag that would deploy in the event of an accident. So that's the whole point of the emergency fund. It is really not to be used for any other reason, and it needs to be kept in a very secure place. 3 to 6 months minimum of expenses. And I would recommend not even investing until these things are even in place. There's no reason, and this is why people lose money in the stock market. Now, I've been investing in the stock market for 20 years. And what I realized is that you can build a tremendous amount of wealth just doing simple things like, consistently dollar cost averaging into the stock market, investing in the S&P 500, picking, some of your favorite ETFs with great track records of building wealth and compounding money over long periods of time. your Vanguards, your Charles Schwab's, there's a multitude of different ETFs that you can invest in, which are nothing more than exchange traded funds, and they're big baskets of stocks that typically, most of the S&P 5, most of the ETFs that I invest in, they track the S&P 500. So this is like easy money, guys, easy ways to build wealth, right? But I wouldn't even recommend investing in these things until my emergency fund is in place. If my emergency fund is in place, I'm not even interested in investing. Not interested at all. It's not the time. And if I'm carrying some high interest credit card debt or any other high interest loans, those need to get wiped out before I even consider trying to build wealth through investing in ETFs, the stock market, or even real estate. And let's talk about just a little bit about long-term investments, which will be necessary, right? So once you get these credit cards and high interest debts paid off, and you have your 3 to 6 months of expenses stashed away safely, hopefully in a high interest savings account, in a strong bank, in a quality bank, or spread across a diversified group of banks. We talked about it in other videos. I can talk about it more if you guys want to understand how to structure that so that you're safer in this banking collapse environment that we're in. Leverage the FDIC. Leverage the FDIC, the Federal Deposit Insurance Corporation. All right, so let's talk just a little bit about the long-term investments that will be necessary because, me personally, I dollar cost average regardless if the stock market's going up, if the stock market's going down. But by doing this, this allows you to take full advantage of the recovery that inevitably happens, right? And, a lot of the news stations, a lot of the different channels out here, and focus on the negative. But what happens is a lot of the opportunities are created during the worst times. When asset values collapse, when stock market goes down, things get cheap. And that's when you should be looking at opportunities. So, you never got to forget what the Fed's doing. What the Fed is doing will always have some significant impact on the economy and on the stock market. And of course, on real estate. In fact, anything that requires borrowing money from a bank. All right. So never forget that you got to understand that, like, this whole economic game is like a game of chess, and you got to keep an eye on all the different chess pieces that are on the board, understand how they move, and understand the impacts that they can have. And when you understand that, then you can essentially have a much better chance of winning the game, achieving financial freedom. By the way, if you guys are new to the channel, please do your boy a favor, subscribe to the channel, drop a like for the video, and share this video with someone who needs to hear this information. All right? Don't get wiped out when there are tools available for you to be able to actually win and come up in these situations and scenarios. So, the key to the role, like the Fed's goal, the Federal Reserve, Fed Chair Jerome Powell, their goal is basically focused on price stability and reducing inflation. When it takes more and more money, more and more cash, US dollars, USD, to buy the same things, that is generally because of increasing inflation. And when that happens, it shows weakness. It's a symptom of weakness in terms of the value of the dollar. And the last thing that they want to do is display that the US dollar's value is weakening. And now the Fed doesn't want 0% inflation. Their target is 2%. So from this point forward, and literally from the beginning of the dollar's existence, it will always lose value. But the rate at which it loses value, their target is 2%. They want the dollar to lose value by 2%. And so this is why I don't want to keep too much money in the bank. There's a certain amount I want to keep in the bank for emergency purposes, daily purchases, paying bills and whatnot. But for the most part, if you don't have a way of creating passive income and increasing your net worth and building your net worth and growing your personal money supply over time, then you will forever be losing money. All right. Warren Buffett said it best. He said, if you don't figure out how to make money while you sleep, you will work until you die. And I don't know if I've heard of a more truer statement than that. So And then also, the Fed, they're going to keep raising interest rates until inflation decreases. So, we're seeing progress on that. Me personally, I expect like the Fed will probably, maybe even not raise interest rates during their next meeting, but we'll have to wait and see on that. But remember, banks make money through interest income. So do you want to make the bank rich or do you want to get rich? And when I say rich, like I'm not saying like, running out buying, Lamborghinis and Ferraris and stuff like that, but like I'm saying like not have to depend on a job. Like, you want to be in a situation where you can choose to work or you can choose not to work. But you certainly don't want to be in a position where if your income stream got interrupted by for some reason, that you and your family will be in a bad situation. So remember, guys, I just want to encourage you guys, drop me some comments down below. Let me know what you guys are thinking. Let me know if I'm making sense. I just wanted to share some concerns of mine with my community because I know you guys are working on building your wealth, getting started investing in the stock market for the very first time, even as a beginner. So these are some tips and strategies I want you guys to be aware of. So just know that these banks, they're not going to publicly announce economic concerns. They're going to keep that to themselves and you won't find out about it until it's too late. So don't be a victim. Don't get wiped out. Drop a like for the video. Consider subscribing. I'm going to see you guys on the next one. Y'all be safe.